can we move forward in towards a responsible way of creating new ways of funding really good plans and teams, and well, I would say ecosystem dynamics, because I think we're just only seeing the beginnings of how tokens and people behave while interacting. So to understand this a bit more better, I've asked the two people who I know well. If I have a question, I ask them. So Scott and Alex, they came here from the United States. So yeah, without further ado, I want to give the floor to Scott. And yeah, looking forward to hear your story on tokens and ICO.
Thank you, Roger.
Thank you.
I'll probably screw this up. Thank you. I enjoy being in the Netherlands. One of the things that's great about my project is that I've gotten to travel all over the world and meet people in the blockchain community all over the world. And the Netherlands is a unique place. It has by far, I would say, from the people I've met, which may not be representative, the highest quality people in the blockchain community in general that I've met, and that seem to be most grounded in reality, which is good for me because I'm very grounded in reality. But I thought I should start by saying my name is Scott Nelson and I'm doing an ICO. I want to explain why. SweetBridge is a very big project trying to do some very big things. I'll spend a few minutes introducing what we do, and then I'm going to explain to you why, when we looked at all the ways we could fund SweetBridge, and I have been a successful entrepreneur, and many of the people on my team have been successful entrepreneurs, we would have absolutely no problem raising money using conventional traditional financing methods. But why we chose not to. And what the reason is customers. So first, let me tell you a little bit about SweetBridge. We're a blockchain alliance for liquid supply chains. By alliance, what we mean is we are trying to pull together all of the blockchain, all of the IoT, and all of the AI projects that are trying to do something related to commerce and supply chain, and bring them together to have a common economics backbone and the ability to actually share common data across a semantic bus. By liquid supply chain, what we mean is liquid capital, liquid assets, and liquid talent. When most people think of supply chains, they think of this picture. This is a very small part of a supply chain. We like to look at it this way. It's either Mother Nature or the supply chain. Everything you wear, everything you eat, everything you use, this room, all are products of supply chains. Supply chains manage 54 trillion of global GDP. This is 2/3 of the global economy of the world. So it's a big area of our lives, whether we know it or not. And the very first problem we're trying to solve is, how do you fix the fact that there's trillions of dollars locked up in this process between order and actual payment? Because unlike when you go to a merchant and buy something, a business doesn't give the other business a credit card. Typically, they send an order and then get a product, and then an invoice gets sent, and then sometime in the future, they make a payment. And we have a very interesting premise. And this premise is built off of some very powerful things you can do with crypto tokens and crypto economics. And that is that you can lend yourself money from assets that you already own without another party, interest-free. And this is possible in lots of ways that I won't go into today, but that's our basic premise. And you can do it on a cell phone, by the way. So why tokens? Why tokens? What's all this noise about tokens? And why is a token business model the right model for us? Well, first, we need to understand that there are 4 basic types of tokens. There are security tokens, which are really just a way of taking historic concepts of profit and creating some kind of tokenization for it. Whether or not it's considered a security in a particular legal jurisdiction, it's a share of profit. There are commodity tokens, which are stores of value. Bitcoin's an example of a commodity token. The vast majority of the crypto market cap value is in commodity tokens. The largest projects are commodity tokens. There are worker tokens, which are tokens that are used to basically get work done. They take a form of trading for goods or services. And there are app tokens, or what are commonly now starting to be called utility tokens. That's probably the more universal term here in Europe, which are tokens which act like a license or an ability to use the system in a way that people that don't possess the token can't use. Now, why is this important? Well, what we are seeing is the creation of smart money. The money that you're used to using is dumb money. It's dumb because it can't do anything, it's just printed on paper. So all it is a mechanism of transfer of value. But the blockchain allows us to actually write smart contracts where we can actually program in value. And what this allows you to do, if you do a very thoughtful job of it, is solve the chicken and egg problem. And the chicken and egg problem in a network business is simply this. Joining a network before the network exists has almost no value. But buying into a token that represents an asset which will appreciate in value over time is a way of incentivizing your customers to adopt your network prior to it having value, okay? And there's lots of ways that you can do this. So, well-designed tokens reward users, not investors. This is a key principle that is not very frequently understood. We have a dual token system, one of which is a commodity token and one of which is a discount or app token. A discount token is a very special subtype of a utility token. And it is an amazingly powerful device. And we're going to share with you why it's so powerful for the rest of our time this morning or this afternoon. So how does a discount token work? Well, fundamentally, it provides a perpetual discount to the token holder. So this is a discount that does not get burned up. So it's not like using a coupon when you basically go to the store and you give them a coupon and you get, so many euros off your whatever. This is something that you can use over and over and over perpetually. And because of this, it actually has an intrinsic value. Now, Bitcoin has no intrinsic value. It has sentimental value. Some would argue it has network value. That's true. I think that's absolutely true, but it isn't the same. This means that you can actually measure the value of the token regardless of its trading value in some kind of exchange. Because you say, well, how much discount power does it give me? How much of a discount do I get on that airline ticket or on my hotel stay or on the clothes I'm going to buy or whatever? And the way it's calculated is like this. So you take the fees and you multiply them by the amount of cancellation you want to reward your user community with. So that's going to be the discount. And then you take your total tokens that are active in the system and you use that to basically divide your discount by that and you get a discount value per token. Now what's magical about this is that as your network grows, the value of the discount per token increases. I'm not talking about the value of the token increasing. Don't confuse that. That may be happening as well. But the value of the discount increases because there's more fees as the network grows, assuming it's a successful network. And as that grows, you get a curve. Now this curve here is based on a 20% quarter by quarter growth, which is a great fast growth rate, but it's just meant to illustrate a point. Now, why is this true? The reason this is true is because you are giving your user two values, not one. Actually, I would suggest you're giving three if you include speculation, but I'm not going to include speculation here. One is, let's compare a user and let's compare an investor. And let's say the user regularly uses the system and they buy a token for a set of tokens for $400. And then over a series of years, 5-year period of time, they use the tokens to get a discount. And they get a $150 discount, or a $120 discount. It doesn't matter what these numbers are, they're just meant to be there illustrative, okay? And we're not showing the value of the token increasing in discount power here, just to keep things very, very simple. The point is, the internal rate of return for someone who uses the token as well as owns the token is better than the internal rate of return of someone who simply owns it and doesn't use it, but owns it as an investment. This means that your users get a greater value than somebody who is an investor. Now, why on earth would you want to do that? Well, the reason you want to do that is because this incents the user to buy your discount token, not somebody who's purely speculating or investing. And users are going to be what you need to build a business. You need customers, and this rewards customers, and it rewards your network as your customer base grows, because as it grows, the people that believed in you when you started actually get a reward. That reward is not some nebulous promise of a future value based on an appreciating asset that is based on speculation. It is a reward based on the value of the discount actually increasing, intrinsic, real economic value. Now, even if you have a large increase, like a 10 times increase in the size of the network over that 5-year period of time, the difference for the user is still better in terms of the return on investment than it is for the investor. So what this looks like is very fascinating, because what happens here is that initially, if you buy a token that's a discount token, and you don't use it for as much as you could use it for, so you buy a little bit, and you start using it, you get 100% of the value of the token, because you get it for using it, the discount you get, plus you get the appreciation in it, whatever happens as a result of the growth of the network. But at some point, if the network keeps growing, you reach a place where you cross over. Where you cross over from having an optimal return, where you're getting 100% of the possible value from your token, to getting less than 100% of the value because you can no longer use it to get more discount, because you'd have to buy things, right? It's like going to the store and going, you know, when my wife goes shopping and she buys something and she says, I got it on sale. Well, but it still costs money, right? So you have a limit to how much you can spend and how much discount you can take based on the amount of need you have for the product or service. And at some point you hit that point. That's the point where the line starts falling. And at this point you hit a place where you start to decrease your return on investment. What this does is that this creates an incentive for your user to release your token for another user, for somebody else. Not hoard your token, because they're suboptimizing their return. Now, of course, if the token's skyrocketing through the roof like Bitcoin did in the last couple of weeks, well, maybe you're going to hold off and wait for a while before you do that. But in general, this is what happens. By the way, I should mention, this is the exact opposite of a Ponzi scheme. You know, Ponzi schemes are schemes where you basically have people investing something into something early, and then the value goes up, and each party who comes in afterwards basically is subsidizing that first party's investment. This is the exact opposite, because as the network grows to the point where you maximize your utilization, you start suboptimizing your return. And that doesn't mean your return goes down. You might still be on an upward trajectory, but it does mean that you're not getting as much as you would otherwise. Now, this is the major point of why we chose to do an ICO and why we chose to use this as the mechanism of funding what we were trying to do. Because a well-designed token incentivizes customers to both buy and use the token. And it is all about getting your customer. Now, I've started a business and grew it to being a multinational firm, over 400 employees and contractors working for the company on a global basis before selling it to a private equity firm. And I can tell you that the hardest thing to do with any business is to attract and keep customers. The other thing that this kind of model does is it creates an incentive for your customers to stick with you. So if the value of their discount tokens is increasing, they have all the reason in the world to continue to use your service or your product. Because anyone else entering the marketplace has to compete, and they would have to start by being able to meet your level of discount, but they can't do that because they didn't build the customer base first. This allows you to create a network effect business out of a shoe store, a network effect business out of an airline, a network effect business out of really almost any business model that has a high utilization of assets. Because the value of this approach is for any asset utilization business. Asset utilization businesses are interesting. Take a software business, for example. I've built a very large SaaS business before. And you spend tons of money and go through multiple rounds of venture capital, raising money to fund two things: the development of your software and the acquisition of your customer base. And those two things are extraordinarily expensive. It is not uncommon in the early years for a SaaS business to spend 70% of its income on sales and marketing. It's a massive, massive investment. And it's not uncommon in the very early years of a SaaS business to spend 40 or 50% of income on software development. These are hugely expensive upfront businesses. But it's the same as buying like a warehouse, or building a hotel, or buying an airline. So imagine a business, an airline, where the people who basically are the customers of the airline get a discount token that's used to fund the airplane. In essence, Alex and I were talking about this on the train ride today. What would happen is you, in the community of the token holders, would hire the crew and the pilots and pay for the gas to fly them because the airline wouldn't have to pay for the cost of the airplane. Now, what this does is outstanding because what happens is we can now create businesses where the cost of capital, whether the cost of capital comes from investors or the cost of capital comes from banks, where the cost of capital can come from the customers who support the business and are interested in its creation and have a vested interest in its stake. And that is something we could not do in the old model. And that is why we decided to do an ICO. The key thing about tokens is economics. They allow us to create a new economic reality in which the world works differently, and many of the things that we believe to be true are no longer true, such as you can loan yourself money interest-free off assets you already own from your cell phone. Thank you.